A customer borrows $500 and pays $75 for 2 weeks. Annualize that price, and the APR is more than 300%. But the lender does not keep all $75, and the customer may not repay the $500 at all. That is the contradiction inside a payday loan company. The company must find and verify customers, finance principal, absorb defaults, run stores, collect failed loans, and keep a license that a single legislative vote can render worthless. We are going to model a hypothetical regional company with 5 licensed storefronts and a compliant online channel. It is not any real lender. In the base case, it makes 150,000 loans in a year, advances $75 million of principal, and contracts for $11.25 million of finance charges. After credit losses and operating costs, EBITDA falls to about $2.3 million. After financing, maintenance capital, and a cash reserve, the owner is left with about $1.63 million before tax and before any owner salary. To see how the same business produces wildly different results, begin with one contract. The borrower receives $500. The lender charges $15 for every 100 advanced, so the finance charge is $75. 14 days later, $575 is due. The customer did not literally pay 391% of the principal. If the loan is repaid once, on time, the dollar price is $75. APR does a different job. It converts a short period rate into a standardized annual rate. 75 divided by 500 multiplied by 365 divided by 14 equals roughly 391%. Both views matter. Saying only $75 hides time. Saying only 391% can hide the actual contract. Repetition changes the dollar story. One $500 loan followed by 6 fee-paying renewals can generate $525 of fees while principal remains outstanding. But a rollover, rapid reborrowing, and an installment refinance are different transactions. The right questions are how much principal, for how long, at what fee, how often repeated, and how much ultimately paid. Not every product marketed as fast cash is a payday loan. Payday loan and payday advance commonly describe small, short-term credit due around the next pay date. A single payment loan is the broader contract shape. Principal and charge are due at once. Payday credit is one subtype. An installment loan amortizes over several scheduled payments, using capital longer and exposing the lender to a different loss curve. A title loan is secured by a vehicle title, so default can lead to repossession. Our modeled payday loan is unsecured. A credit card cash advance draws against an existing revolving line. A bank small dollar loan and a federal credit union payday alternative loan operate under depository rules with longer terms and lower caps. They are not storefront payday loans. Distribution is not legal status. An online lender may be state-licensed, bank-partnered, tribally owned, or illegal. A state-licensed storefront lender can also accept applications online. Cash advance apps may monetize subscriptions, tips, expedited transfers, or interchange. Employer-partnered earned wage access may deliver wages already earned and be non-recourse. Direct-to-consumer apps may estimate wages and debit an account later. Similar use does not make every structure legally identical. An illegal, unlicensed lender is outside our model. Our company sells one specific thing: legal access to $500 now, secured by a promise and payment authorization, with $575 expected 2 weeks later. Before it can sell that promise, it must decide whom to trust. The base company receives 60,000 applications in a year. 45% pass its initial approval rules, but applications, approvals, and funded unique borrowers are not the same measure. Duplicate applications, abandonment, verification failures, and declined offers reduce the funnel to 20,000 active funded borrowers. Traditional underwriting asks whether a borrower can repay from income without needing another loan. Payday underwriting has often been narrower. Verify recurring income and an account into which income arrives, then limit loan size. Federal mandatory ability to repay provisions proposed for payday lending were revoked in 2020. But state rules, unfair practice law, and a lender's own risk controls still matter. Repayment may be supported by a post-dated check or automated clearinghouse authorization. Permission to submit a specified debit, not ownership of the customer's account. If the account lacks money, the lender may incur a returned payment cost and charge a permitted fee. Separately, the customer's bank may charge an overdraft or non-sufficient funds fee. Those are two different revenue and cost lines. Repeated debit attempts can multiply harm without producing payment. Federal payment rules became operative on March 30, 2025. After 2 consecutive failed transfer attempts, a covered lender generally needs new, specific authorization before trying again. The Consumer Financial Protection Bureau then announced that it would not prioritize penalties or fines tied to those provisions while considering a narrower rule. Non-prioritization is not repeal. Getting the first loan repaid matters. Getting the same customer back can matter even more. The base company serves 8,000 new borrowers and 12,000 repeat borrowers. Across all 20,000, it originates an average of 7.5 loans during the year. That average is not a claim about the industry. It is the engine of this editorial model. A first-time customer might cost $150 in advertising and lead expense. The lender also pays for identity, fraud, and bank data checks while facing greater uncertainty. A returning customer can arrive through an owned email or a direct login, and the company already knows how that person repaid. The principal can also revolve. If $500 is advanced for 14 days, repaid, and advanced again, the same capital can support many transactions in a year. The lender is not earning $75 once on an asset held forever. It is trying to earn a fee each time short-duration principal completes a cycle. This creates the central controversy. The company can call repeat use customer preference and recurring emergency liquidity. Critics can call it a debt cycle on which the revenue model depends. Both sides argue about the same unit economic fact. Fewer repeat transactions can destroy profit. In our base sensitivity, reducing annual loans per borrower from 7.5 to 5.5 moves owner cash from positive $1.63 million to negative $340,000. The ethical question is whether the product bridges a timing gap or monetizes a permanent monthly deficit. For the company, repeat frequency creates gross charges. It does not create cash unless the principal comes home. Our company advances $75 million over the year, but it does not need $75 million sitting idle on January 1st. With a 14-day average term, simplified average principal outstanding is annual originations multiplied by 14 and divided by 365, about $2.88 million. Seasonal peaks, failed payments, and settlement timing require more liquidity, so the company also holds an equity cushion. Principal can be financed with retained cash, equity, a warehouse facility, private investors, or securitization. A warehouse lender advances against eligible receivables. The payday company supplies the remaining equity and bears first loss risk. Our base facility costs 12.5% annually on simplified average outstanding principal, or about $360,000. That is only $2.40 per originated loan because the principal turns quickly. But a facility can exclude delinquent collateral, cut its advance rate, demand reserves, or terminate after a regulatory event. The company can look profitable and still fail if it cannot fund tomorrow's loans. Longer installment terms also keep principal outstanding and losses uncertain for far longer. That machine works only if most principal returns. When it does not, a $75 fee can be overwhelmed by a $500 hole. The base company originates $75 million of principal and assumes 5.5%, or $4.13 million, ultimately defaults on a dollar basis. This is principal dollars charged off, not the share of borrowers who ever miss a due date. The company recovers 22% of defaulted principal through later payments, collections, settlements, and possible sales of charged-off accounts. Recoveries are about $908,000. Net credit loss is therefore about $3.22 million. Collection costs another $420,000. Collectors remain subject to law. Wage garnishment generally requires lawful process. If the principal default rate rises from 5.5% to 7.5%, base owner cash falls from $1.63 million to about $455,000. If recovery falls from 22 to 12%, owner cash falls by about $413,000. One default can consume the fees from several successfully repaid loans. The next leaks are smaller per loan, but they arrive on almost every transaction. 5 stores cost the base company $1.65 million a year. That covers rent, staff, cash handling, security, and local operations. The store is both a distribution channel and a trust signal. Location creates controversy. Payday stores have often clustered in lower-income communities and areas with fewer mainstream credit options. Operators point to rent, traffic, and demand. Critics point to targeted extraction from financially vulnerable neighborhoods. Online distribution removes cash drawers, but not cost. Search advertising for urgent phrases is competitive. Affiliates and lead generators can collect identity, income, employment, and bank details, then sell a lead to a lender or to more than one. That creates 2 questions. What does a funded customer cost, and how was that person's data collected and resold? The base model spends $1.2 million to acquire 8,000 new borrowers, or $150 each. It also spends $550,000 on technology, data, and identity verification, and about $308,000 on ACH and payment processing. Closing the stores does not make those expenses vanish. In our online-only sensitivity, store cost falls away while customer acquisition rises to $225, and technology, compliance, and legal reserves increase. Owner cash improves only modestly to about $2 million. And unlike advertising or rent, the largest pricing constraint is set by law. The United States does not have one payday price. Kansas permits a licensed short-term advance of up to $500 for 7 to 30 days and caps the charge at 15% of the advance. Florida permits a different maximum term and fee. California historically limited the face amount of a deferred deposit check to $300. Texas uses a complex structure involving credit access businesses and local ordinances. Other states use 36% caps that make this 2-week product uneconomic. Several jurisdictions prohibited, repealed, or sunset classic authorization, while Ohio and Virginia moved toward longer amortizing products. Payday lending is legal, can mean a fee-authorized single payment, a reformed installment product, or another licensed small loan. No company can copy one contract nationwide. Licenses, databases, cooling-off rules, rollover bans, and income limits change the system. At the federal level, Truth in Lending controls cost disclosure. The Military Lending Act imposes a 36% military APR cap for covered service members. The CFPB supervises covered consumer finance conduct, and the Federal Trade Commission can challenge unfair or deceptive practices. State regulators decide whether the core product may exist. Our strongest sensitivity is a fee cap. Reduce the base charge from 15% to 10%, and gross finance charges fall by $3.75 million. Owner cash moves from positive $1.63 million to negative $2.12 million. A legislature does not need to confiscate the stores. It can change one number in the revenue formula. Tribal lending cannot be explained honestly as either a magic exemption or a fake label in every case. Federally recognized tribes possess sovereign authority. A lending enterprise may be created under tribal law and contribute meaningful revenue and employment to the tribe. The legal dispute becomes whether a state can apply its lending cap to transactions with its residents, whether the enterprise is genuinely controlled by and economically connected to the tribe where the lending activity occurs, and which federal laws apply. Some non-tribal operators have been accused of using tribal relationships to avoid state caps. Regulators and courts examine facts, not marketing labels. Federal law can still reach deceptive disclosures and collection conduct. For a state-licensed company, tribal lending is both competitor and warning. Higher online pricing may attract demand, but also enforcement, litigation, and payment processor exits. If licensed Payday stores disappear, customers do not stop experiencing car repairs, utility shutoff notices, or gaps between paychecks. Some shift to bank overdrafts, family, employers, pawn loans, installment credit, or delayed bills. Some may encounter illegal lenders. The empirical question is how much demand moves to each substitute and at what total harm, not whether emergency demand vanishes. The fastest-growing substitute now sits on a phone and often insists it is not a loan at all. Consider an earned wage access provider. An employee has already worked the hours but will not be paid until Friday. An employer-partnered service advances part of those accrued wages and recovers the amount through payroll. If access is free to the worker, does not exceed earned wages, is non-recourse and avoids debt collection or credit reporting, current federal advisory guidance can treat that covered structure as outside Regulation Z credit. Now consider a direct-to-consumer app. It estimates upcoming income, advances cash, debits the user's bank account after payday, and earns money from a monthly subscription, an expedited transfer fee, interchange, or a requested tip. The experience can resemble payday lending: receive cash now, repay after income, use it again, while the legal mechanics differ. Federal data found a $106 average employer-partnered advance and 27 annual transactions per user. A $3 fast transfer fee repeated that often is $81. A December 2025 advisory opinion took a narrower approach for qualifying earned wage access and withdrew a broader 2024 proposal. States can still classify these products differently. So is an app a payday loan under a different label? Sometimes the comparison is economically useful. It is not a universal legal answer. We now have every pipe in the system. It is time to follow the $11.25 million of gross charges to the owner's account. The base company makes 150,000 loans at an average $500 principal and $75 fee. That produces $75 million of principal originations and $11.25 million of gross finance charges. Refunds and fee waivers remove $250,000. Net principal credit loss removes about $3.22 million. Warehouse funding removes $360,000. Payment processing removes about $308,000. Collections remove $420,000. New customer acquisition removes $1.2 million. 5 storefronts remove $1.65 million. Technology, data, and identity. Verification remove $550,000. Licensing, compliance, legal and audit remove $600,000. The complaint, Litigation and regulatory reserve removes $400,000. What remains is about $2.3 million of company EBITDA, corporate financing cost, maintenance capital, and an added working capital reserve remove another $670,000. Owner pre-tax distributable cash is about $1.63 million, or $10.84 per originated loan. The weak company has fewer applicants, lower approval, only 5 annual loans per borrower, a smaller fee, worse losses, costlier funding, and less efficient acquisition. Fixed stores and compliance do not shrink fast enough. It loses about $4.03 million. The strong company combines more borrowers, 9 annual loans each, an $84 fee, lower loss, and cheaper acquisition. It leaves about $10.25 million before tax and owner salary. That range is the answer to the title. Owning a payday loan company is not a license to keep a 391% return. It is a short-duration credit factory in which small fees must outrun principal losses, acquisition expense, storefronts, funding, and law. And the variable with the most power is not the APR printed in an advertisement. It is whether